Ooh, wait a second. Good afternoon. And it's Thursday. So I am so excited to be here. It's 1 o'clock. And oh, hang on 1 second. Why is that guy doing that? Well, I don't think you want to listen to Trump in the background because he's on all the time. So today, I am so pleased to be here. And joining me is Leonardo Dieste, investment specialist from the Scotia Bank. And John Cliff is joining us as well. And I'm sure that they have some wonderful things to talk about. But I want to show you this. Let's see if I can do this. Hang on. So can everybody see this? Look at this. Aren't they darling? The bulls go moo, the bear goes grr, the lemmings go. It's a different time. So join me in welcoming Leonardo. Hello. I love that. Did you see that?
Hi, thanks. I borrowed / stole that from a presentation from one of our portfolio managers.
They're
Kind of
cute.
that speaks of, yeah, I like it. I kind of that speaks about what we're facing as with the behavioral the behavior of investing, or the psychology of being an investor. Sometimes it's filtering out news and the distractions that we might encounter on a daily basis via our phones. It's certainly different this time in the sense that it's something that we haven't crossed before, as far as the effects of a global pandemic. Yet, when we take a look at other market periods where there has been volatility, it's always been different. And it's the adage of there's a saying in Spanish: you never know when the hair is going to jump, and the idea is that you never know which punch is going to get you, kind of a thing. So the importance of sticking to a well-prepared financial plan that is tailor-made for your needs provides the strategy on how to surpass periods where we are bombarded with facts, news items, and distractions that might question or might make us question the period that we live in. So the bull is representative of a soaring stock market. The bear is representative of a stock market that's sluggish, and the lemmings are us, or our thoughts anyway. Sometimes when we try to tell ourselves that no, this time the stock correction is difficult. This recession is going to be different. This time it's going to get us. Look, all we know is that assets go up and down in time, and the average of those assets, that positive return is what makes a difference. It's not the timing of the specific market, but the time in the market, and that's dictated by a tailor-made retirement plan. I wanted to bring some news today to you folks in regards to what the markets have been doing, and it's been a little bit of a sluggish week. I wish I had really exciting things to tell everybody, and there are some exciting things to tell everybody, but overall, it's been pretty sluggish. So I don't know if you remember, a few weeks ago I talked about going 2 steps forward and 1 step back, 3 forward and maybe 2 back, or 1 back. That's kind of what we're seeing. We had a very, very strong returns as far as index in April, where Canadian bonds on a 1 month average were close to 4%. The S&P 500 at 10.79, global equities at 11, and U.S. equities at 12.82. So April was a stellar month, and I think this week has been a little bit of a slower week as far as returns. We've seen some retraction in the Dow Jones. Yet that's the principle of the guiding principle, whether you weigh it out on a long-term basis or a short-term basis, is it's the average of those positive months and not sitting on the sidelines that makes a difference in your overall return. So yesterday, the North American markets fell sharply, and by sharply, I mean that the Dow Jones fell about 500 points.
Right.
I think it's close to at a high 22 or a low 23, and the S&P at TSX Composite Index declined. Now, that doesn't tell the whole story, because as an investor, you might be invested in specific assets through the solutions brought forth by your investment specialist or financial planner or investment person, and those solutions might should be vetted. The holdings should be vetted. So my example here is, well, we hear some of this information or these news items that, in the short term might cost us or our lemming brain to be, well, no, it's different. Then we hear news where there are certain factors in the Chinese markets that are moving strongly. The luxury markets in China uh, uh, have been increasing in sales. I was informed by one of our portfolio managers that Chanel increased all of their prices by 25% because their demand
What?
dictates that. Yeah, in China. So Nike had good sales there and abroad, and other companies like um, you know the usual suspects in these times: Amazon because of their strong balance sheet, Microsoft, and many other stalwarts of their realms have had a quite good performance through all this time. So an index doesn't tell the whole story, because your investment should be more than just the index, or we could use an index if it's suited. So a that lastly, that falls within my last piece of advice, and my last piece of advice falls with a the idea of putting diversification to work. So if I can share my screen real quick. Um, yeah, uh, because we don't know what's going to be the best asset class to hold each year, um, what I love to show is how being diversified and having your eggs in many different baskets that fit your retirement plan can work out on a rolling average, because our timelines are not dictated by today or yesterday. They're probably dictated by the plans we might have in our life. Those plans might span 20 years or more, and sometimes might be 5. Yet that's the range of some of the planning that we do. So just wanted to highlight that regardless of which asset class, in this case, it's Canadian small cap in 2010 did well. Kind of the sweet spot is a balanced portfolio works out to providing a picture that's satisfactory for positive returns, and in this case, in comparison to some of its asset classes, less risk. And it's simply the idea of owning a little bit of everything in an intelligent way with intelligent or with high quality portfolio management, and that those averages over the year are gonna work out, rather than picking which is going to be the winner or the loser in one year. And in that, kind of to uh, to illustrate the importance of sitting or staying in that balanced portfolio. This is just, I know I've showed this before, but if you have
Mhm.
10, it's just illustrating if you've invested $10,000 in 3 different ways over a 10-year period, um, and if you invested $10,000 and 100% of that was in a balanced portfolio in a 10-year period, you'd be walking out with $20,000. If you did a 50-50 split, and you'd be at $15,000. But the worst thing to do is to leave it in cash in this example, and just wait for that moment in time, because if that moment in time, um, if we're just kind of waiting for that moment in time, it's never particularly going to be a good moment in time. The last 20 years, we've had some kind of scare, or concern of why not to invest in a market. Yet, even this year, a balanced portfolio has held its weight, especially when looking at it on a long-term perspective. Now, please don't get me wrong. I'm not saying, hey, put your emergency fund in a balanced portfolio. What I'm trying to say is, with a tailor-made financial plan, you can achieve some of your long-term goals using the tools that I might be able to suggest. And again, make no mistake, don't go putting all of your emergency money in a balanced portfolio if you're going to need it in 3 months. This is usually a 3, 5, 10, 15-year kind of timeline that I would recommend these investments to
So,
make a difference for you.
So when you're managing a client's portfolio, do you engage in a discussion as to, on a regular basis, what their tolerance is, or are you and your investment specialist making these decisions?
We need to discuss that. So I know when we're talking about our initial exploration of understanding a customer, and part of understanding a customer is asking those questions and seeing not only on a numbers basis. So that involves knowing how much of an emergency fund is needed, but not only needed, sometimes what's psychologically needed as well, because there might be a gap. You might only need X amount of money to feel that, or to know that you're covered for the next 6 months or 3 months. Financial planning, we usually use 3 months. Sometimes we extend it, but psychologically, you as a customer, you might need 2 times that, and that's perfectly fine. That falls into the risk. To answer your question specifically, we in the conversations that we have, risk or openness to risk is talked about. I usually advise on the conservative side of that thermometer, and it's in our follow-up meetings. We usually happen 3 months, 6 months, and then every 6 months, unless something new were to happen in this customer's life, we re-examine that risk, or that openness to risk. Now, when I say risk, I don't mean you go from 100% returns to 0% returns. I'm a slow and steady kind of guy. And we talked about cycling a few times before, and I've been called a diesel because when I'm out on the road, it's like you can never get rid of me. I'm not beating anybody, but you can never get rid of me, or you can rarely get rid of me. I'm not sprinting anywhere, but I'm still around like a buzzing bee. So that's kind of my approach for.
That's pretty cool. But then it's tried and true, and you know how long a diesel engine lasts, right?
Yeah, that's that's the important part, I think. If this first quarter has taught us a lot about the psychology of investing, and how open people are really to fluctuations in their investments. Because prior to this quarter, our previous memory of a stock market correction was 2008, of a real one, of a quantifiable real one, where we can all agree, we can all agree loudly when it happened, and that was 2008. So when people were meeting their advisors in last year, the numbers looked quite good, for a lot of investments that perhaps and perhaps people were guided more about the idea of making that number or by profit rather than is the investment class actually aligned with your risk. So what I'm trying to say here is that an investment that participates more openly in fluctuations or volatility or ups and downs, might have had an average, just putting something out there out of top of my head, is like 11%. On a long-term basis. And some people, I'm only guessing because this is not how I get my customers, but I'm guessing that some people looked at that 11% and said, hey, I really want to make 11%. Yet they weren't ready for that, retraction of minus, 20% in that first quarter. Now, the idea is of you kind of using a diesel method is, ensuring that that your retirement needs are met, but using a strategy that if we have a retraction like we just recently did, hey, it's not what we're looking for, but it's we can stomach it because the risk of that investment is appropriate for that customer's not only behavior but needs.
I have an example question for you. So
Yeah.
I had this discussion yesterday with a client, okay? And I remember this discussion as well about 5 years ago, okay? So grandma and grandpa have lived in their home for, let's say, 50 years, okay?
Yeah.
And so I've sold the property, and it's, of course, clear title, all right? And so at the time, they, let's say, for example, they netted $350, but then they're going into a facility, right? And our facilities here, if you're lucky enough, it's subsidized by the provincial government, but depending on your needs, you have to top it up. So if you're topping it up, let's say as a couple, you're topping it up $2,000 a month. Okay.
Yeah.
Now you can put the money into a checking account. Okay. Now follow me on this. This is because it's so easy for me to tell you because it actually occurred. Okay. So you put the money in a checking account and then you're paying all of this stuff every month, right? And whatever it is they need. And so year one, right, you see what's happening to the balance, right?
Yeah.
So 5 years later, let's say they're spending $30,000 a year or $36,000 a year. So 5 years later, Leo, how much have they spent? Okay, we're getting to the 50% mark, correct?
Yes. Yeah.
Yeah. Okay. Now they're still alive. Okay. And even though they're getting up in age, they probably live another, let's say, 3 to 5 years. Okay. So, of course, in the end, there's not really a whole lot of money left for distribution to their grandchildren. And, everybody has a will and they want to leave things, yes? But if this is all they had, my question to you is, with this $350, if it was handed over to an investment specialist like yourself, okay, what could the past 5 years have yielded on an average per month? Would it yield enough to subsidize what they were living in? And then by the time they're finished, at least the principal may still be there, or a majority of the principal instead of 50%. Sorry, it's such a long question. I had to set up this.
It's tough to answer specifically without running the numbers. But I do run the numbers when we meet for a planning meeting. But in this situation, I think, if you want my opinion, we have two different things, or maybe three. One of them is, you have this money not working for anybody. It's definitely not working for the customer. And it's certainly not working for the customer and leaving a legacy. So the reason why it's not working for the customer, period, it's because this capital is being eroded by inflation every year on a compounding basis. So maybe this year we won't have inflation, or maybe we will, I don't know. I don't have a crystal ball, but we are, when we do our planning, our planning calculations, we are mandated to use a 2% average a year inflation.
Mhm.
So they're losing about 2% on 2% on 2% on 2% on 2%. The So that's not really doing much for the customer, because again, leaving it in a checking account um, might not be the right way to preserve that capital. And and if, for most people, a home is an asset of pride, and is an asset of legacy. And in this case, it's completing its almost useful cycle as an asset of carrying me on forward in retirement. Um, but it doesn't have to be all or nothing. And the reason I say this is because now the asset of a home has completed it's become cash. So it's completed
Right.
its life cycle as a home. Now we can use that asset in perhaps with different strategies, short term and long term, to help fund those expenses in in that final part of retirement, in a way that is not completely eroded, essentially. And the question is, again, you know when you have $350,000, and if these were my customers, I would definitely not recommend we invest everything in the markets. We'd have a very hard look at their expenses, and we'd have a look at their emergency fund. And I might even advise for a full year of emergency funds to be easily cashable for them, depending on the conversation, which would we have to add on the sidelines. But the rest can complete the purpose of keeping up with inflation, keeping up with better returns, and also hopefully being used to patch up any shortages possibly in that cash portion, and also finally to be used as a tool for leaving a legacy for children, grandchildren, loved ones, etc.
So either way, having this money sitting in that checking account really was not a great idea at all.
Well,
Even
yeah,
if you set aside 150,000 of it, right, in a checking account for emergency or whatever they're doing, or you put it, as you say, maybe in a short-term deposit, but $200,000 of this money should have been working extraordinarily hard for the past 5 years. And, typically when I tend to move people out of these residences, right, I mean, there's at least 5 or 10 years left to go, right? So, but yeah, no, I had a feeling that you would agree with me. It shouldn't be sitting doing zero, waiting for some sort of rainy day that I might need it all. Because at that age, for most people, they don't need all of that.
well, I think, yeah, I think I agree 100%. Is, at what moment well, maybe they're going to buy a Lamborghini. Like, at what moment in time do we stand up and say, I am going to use all of my, cashable retirement assets in one go?
Mm-hmm.
Especially if they're $350,000. Especially with the kind of situation you've described. The this money, it sounds like these people we've all worked hard to build equity in our home, and for some people, that equity we've built in our home is part of a retirement strategy when going into a long-term care facility. So my question is, and I think this is where you're getting at, is why do we stop planning at that moment if we
Correct.
still have 5, 10, 15, 20 years? I don't know these specific situations, but I have heard of. I have encountered customers that or have customers that that they've been in retirement for a significant amount of time.
Mm-hmm.
So So
We're talking,
yeah,
but that's correct, right? But we're majority, and we do have John Cliff visiting, and maybe John might have a question related to this in terms of investment, because on his side, I see this a lot, Leo, where they've stayed in their homes till their mid to late 70s. So we're talking a couple, let's say they're in their early 80s, which is, and then there. Hi, John Cliff, welcome you from the Mortgage Center. Thanks for joining in. So I hope you heard that question, and I'm just going to, continue with this because I think it's related a bit to what you have seen. So a majority of Albertans, believe it or not, right? If we don't move at 60 or 65 into our next, residential situation, what we're finding is a lot of couples are in their homes past 80 or late 70s, 80s. Okay. And so by the time 80 rolls around and they're moving into assisted living, someone else is now making decisions for them. And that someone else is typically the person that they that's going to inherit. That's one, or is the executor, two, or the person that has, power of attorney over everything. And we all have someone in our lives that we trust and has power of attorney. Okay. And so what I'm seeing is the people now in charge, not grandma and grandpa or mom and dad, are making these decisions where, yes, I've sold the house. Yes, they're happy with what they netted because it's their principal residence, tax-free after fees and whatever. And yes, it's in a checking account. And it's sitting there. And as they pay the, you guys know that, most situations are subsidized anyway by the government. So a couple may have to pay another $2,000 or $3,000 a month depending on the level of the facility, right? So the money is sitting there to pay these things, but some of these lovely couples, right, will live 5 or 10 more years. We're seeing that. So no one is concentrating on that, a portion of that, if not most of it. I mean, if you had 300 or 350,000, from where I'm sitting, I think 200,000 should be invested somehow, at least earning. It's working. The money is working instead of being dead. So, John, I don't know if you run into situations. We talked about reverse mortgages before, and I know that you had said you're a big fan of it, but it comes back to Leonardo and investments. And for me, the big thing is you have to make money work for you, okay? And money, when I sit here, and it sounds really basic, but no matter what age you are, you can still make the money work, even if you're 70, 80, and 90. So
absolutely.
Back to you two.
And no, it's interesting you say about the reverse mortgages. I'm not necessarily a fan because it really is specific to a situation. But if you think about it this way, anybody who has deferred their mortgage payment because of COVID, you are temporarily in a reverse mortgage.
True.
You're not making any payments. You're not paying down any principal, and they're adding the interest onto what you owe. So you're actually experiencing what a reverse mortgage would be like. They can be useful, but in a very specific situations. But it's interesting you bring up the savings. We were doing a first-time homebuyer seminar last night, and we were looking at it from the opposite end. So rather than when you're finishing, it's when you're first starting and first buying a home. And we were talking about the first-time homebuyers incentive, where the government will put in up to 10% for new construction. And it's not getting a lot of traction. And I find that interesting because when we ran the numbers, say on a $375,000 purchase on a new construction, the government's going to put in $37,500, and 25 years from now, you'll owe them 10% of whatever the value of your home is. But what ends up happening is Now you're in the 15% down category for CMHC fee, not the 5%. So right out of the gate, you save $5,000 CMHC insurance fee. In addition, because your mortgage is smaller, you're going to save $5,000 over the first 5 years in interest. Now here's where it gets interesting. Because your mortgage is smaller, your monthly payment's going to be about $200 less. Now, Leo, you can check this for me, but by my calculation, if you stuck $200 away every month into an investment that's earning 5%, 25 years from now, when you have to pay the government back, you've built up $120,000 of savings. Now, let's say your home is worth 500 then, and you owe the government 50. Guess what? You're 75 grand ahead of the game. And I find it surprising that not more new home buyers are taking advantage of this. It's an incredible opportunity.
So in the seminar, for example, was it well received? Because my thing, often I find it's not explained as, like you just explained it, in English. So people understand right away the lump sum savings, and who wouldn't want a bank account with $120,000 extra found money? So it's how it's communicated, right? So it comes right back to, investing with Leo, right? All of this, right off the bat, you got $5,000 extra, right? Not to mention, as you say, you're saving as you go. But anyway.
Yeah, it was an eye opener for folks because, I mean, not even the government explains it that way. And as you know, we try to educate people about mortgages and how they work, and we try to do it in plain English when we can. And usually when people start to learn more about mortgages and how they work, just by natural situation, their financial literacy starts to improve and they start to think about things differently. Like, yeah, maybe all I have to do is put $200 away every month for 25 years. And that's not a big ask.
Was it a week or two ago where I said, can you not insist these kids put away that kind of money every month automatically?
Yeah. And I'm sure, Leo, you've got programs where they can set it and forget it. And, they're in nice, safe, long-term, kind of boring 5% a year kind of stuff. And, if they do that in a TFSA, that 120 grand is going to be completely tax-free as well. So at the end, you cut a check to the government. You say, hey, thanks for the free ride. You're out of here.
So with the TSFA, Leo, you can put in any amount you want, to the maximum, I mean.
Yeah, everybody has an amount dictated by CRA, and that has to do with your age, how long the program has been in place, and they have a calculation of what you put in versus what you've taken out. So let's say somebody hasn't started with a TFSA ever, and they meet all the requirements. Residence in Canada is a requirement. And that's 180 days plus 1 day per year to get that amount. So all I'm trying to say is CRA would have that information as to each individual, as to what they can add to their TFSA. And if you've never used it before, you can put all that money in one go, and that money can grow. So let's say you invest $50,000, $100,000, and that doubles. That doubling is, all of it is tax-free, but that doubling continues to exist inside the TFSA. One of the big questions that I get is, hey, look, my limit is X. And it can, once I start making money on this, do I need to take it out or do I get taxed? No, the government's just counting what you've put in and what you've taken out to assess your, and the other qualifying criteria to assess your total TFSA limit.
So yeah, it would have been kind of cool. Yeah, okay, it's the TSFA. But you manage the TSFA, correct?
Yeah, well, if
somebody opens one with you, then you're making investment decision, or all of it goes into something, right?
Yeah, depending on the conversation, the TFSA is a tool that I often use.
Okay. Now, and so if someone hasn't opened one yet and they want to open one today, Is there a minimum amount of money they need to invest in a TSFA that you open for them?
We'd have to have that conversation. There needs to be a minimum for things to get going.
Right.
So, that would be however, technically we could open a TFSA with $0 and then work on the rest later. So I do have a minimum in investable assets of advisory, yet
Right.
we can look at the TFSA and if you want to invest $0 today, but you're going to add more tomorrow, then that's fine as well.
True. Okay. But nobody should leave zero in there. Leo is going to be zero. Okay. And the reason why I asked that question, is, but you guys correct me if I'm wrong, grandparents and parents, right? Of course, I mean, depending on the age of the children, there's the education, right? Every year the government contributes X number of dollars to a savings account that's structured for, say you start it when the child is small, right? And so now that child is 18, okay? So you said you had to be 18 and older to open a TSFA, is that correct?
That is correct, yeah.
Yes.
Yeah.
Okay, so if that child decides not to go to university, or if they do, whatever, most people want to still contribute to their grandchildren's well-being. So is that something that you recommend as a grandparent, that you open a TSFA account that's administered by you, where the beneficiary of the account really is a grandchild?
So there's a few ways to accomplish that goal. And I do recommend that if people have a surplus and they want to help or aid their children or grandchildren with an investable asset, that tax-free savings account in the name of the grandchild or child could be a good idea. The other way that can be achieved is by using the TFSA as an estate tool. So that's a different part of that similar conversation. It would depend on the client's specific needs and investable assets in total. So to answer your question directly, can a grandparent use the child's contribution room? Yeah, the child, in this case, an adult. Yes, of course. We would have a conversation amongst the three of us and see what is a suitable investment. It's happened with a lot of my clients that they have surplus savings that they want to put to work, and also put to work for their children's future, and as well long term. So we have set that up before. The other part of that
is there a way, though, because it's in the child's name? You said the word trust earlier in that statement. So my question is there a way to keep that child from deciding, oh, I need the money, I'm going to buy a truck now?
Nope. Nope, because it is a registered investment.
Correct.
As it is a registered investment, it's in that young adult's name, and that young adult is ultimately the person who has the responsibility of signing and proceeding with that. So that's why I had brought up the idea that an individual's tax-free savings account facilities could be used as an estate tool, and that is either the tax-free savings account is actually really cool, because you can set up a successor, which is technically your common law or your spouse, and they can take over that tax-free savings account at the moment of death, and without any tax implications. So that's how a TFSA could be used as an estate tool. It can also be used as a tool of an estate you can assign secondary beneficiaries. So let's say I, Leonardo, have a successor as my partner. I've set up the tax-free savings account successorship for my partner, and then the secondary beneficiaries would be Tim, Tom, and Susie, and those are, let's say, my grandchildren, and I'll split that 30, 30, 30. So that's a way of achieving a similar maybe not a similar, but using the TFSA as a tool for these things.
Cool. Okay, I sent you a message, and thank you for that. For working behind the scenes there to tell me that 350 invested is pushing 500,000 after 10 years. That's crazy.
Yeah, that's in a balanced income portfolio.
Yeah,
and as John would call it, it's a boring portfolio.
but Leo,
but that's what we need.
As a grandparent, when I'm finished, and I praise be, you live to 90 or 91 or 95, God willing, and you have your mind, I would feel horrible to have used it all up because I needed it to live on in the nursing home. And I have nothing to leave my darling grandchildren who come and visit me. They have to visit me all the time. See? So this way, even if I utilize some of it, to subsidize what the government looks after me, I would still be able to leave them something. So that was the whole point of that. Because, John, I don't know if you run into this, but, there's grandma and grandpa, and they got their clear title little house, right? Okay, and it's not so little. The average price of a home in Edmonton is still, pushing 400, right? In some of these communities, for sure. And they're all clear title. And I've seen where it's sold, and there may be 3 very old children, and it's divided amongst 3 right then and there. Boom.
Yeah.
So there has to be different things. I think, honestly, I believe it is all about re-educating. And I agree, John, it starts at the first-time home buyers, okay? And I've been, Leo, I sent you a message there. I've been having these discussions with a 23-year-old, okay? Because as I say to this 23-year-old, we want you to turn 60. You are going to turn 60, provided, you're into some extreme sport or something, right? The odds are in a young person's favor that they will get to 60. I'm sure Leo thought he would never turn 30. But
here we are at 35.
Yeah, I have to say, and I'm so pleased that you guys have met each other a few weeks ago, and I'm delighted to hear that you're trading and information and promoting each other, which is fantastic. But John, I'm a big fan of these investment seminar things with the clients, right? So you mentioned you had a first-time buyer seminar. Obviously, it was online like this is, right? But, I mentioned to Leo, I think it was last week, right, that I wanted to bring together people in a seminar who we found $100,000 for, okay? They're sitting on $100,000 and it's not working and it's in their residence. So we need to kind of move forward. Did you give any thoughts to that last week? John, you were here.
Yes, well, yeah, no, absolutely. That's certainly one idea, is you could harvest some equity out of your home and put it to work for you with Leo. And, if you're concerned that maybe house prices in Alberta are going to stay flat or decline over the next 5 to 10 years, that money that's locked up in your equity isn't really going to be working very hard for you. In fact, it may actually be eroding a little bit. So, right now. And couple that with interest rates being at historical lows. I mean, if you can pull money out of your house at say 2.5% and put that to work with Leo, who's going to earn, what's your average, Leo? 11%, did you say?
That was previous.
If we're using, as you say, something boring over the long term, we have historical returns. Let's call it 5%.
Sure.
On a boring, safe. I don't want to say safe's a risky word to use, but conservative, okay. Balanced.
Conservative. Fund. There you go. So you're gonna earn,
right?
You're gonna earn. You'd be earning double what you're paying, but you're actually paying less than the 2.5% because you're using the money for investment purposes. You can deduct the interest that you're paying to borrow that money. So
So-
you may be effectively paying, 2% or 1.8% or something like that. And Leo's, banging away every year, 5%, 5%, 5%. And meanwhile, the money is stale.
I think Leo will do better for the clients than that, but that's better than 0 or 2%. And if, I was in an interesting 1-hour conference this morning. It was done via telephone. What did we call those? It was fantastic, actually. I hadn't even considered that instead of a video call, you're doing a telephone conference call. So listening to the chief economist, the BMO, and also to Dr. Elaine Chin, who is the executive director and founder of the Executive Health Center in Toronto. Oh, Doug Porter is the chief economist. Yeah, there we go. Doug Porter. It was interesting little tidbits, right? I loved what she said. At some point we have to get, she called it death by COVID or death by economy. Okay. And the chief economist talked about, he said that we may come out of this with lower inflation than we went into it. Okay. And of course, the gold prices are at an all-time high. And Dr. Chin's concern was, of course, probably opening up too soon and then the second wave. What we're going to take away from what she said is this virus. She believes that everyone should wear a mask. We're not talking a cloth homemade mask when they go out into an area where there's more people, drugstores, grocery stores, probably any, right? And sunglasses, because it's proven that, through the eye. And she says we use what we know kills it, which is alcohol, so hand sanitizers. But, back to the chief economist, right? He, our debt's like $300 billion. That's a lot of money, right? So, but we're seeing opportunities though, too. I mean, as he said, people are trying to figure out to get the people back to work for sure. And I don't know, I probably was off base when I said to him that we keep going the way we're going, that 300 billion is more like $600 billion. Because if Dr. Chin is correct and there's another, like there might be another surge or a wave of this, then we are helping people right now with $2,000 a month for 4 months, right? So does that mean they're going to go back to work? I'm hearing that people are not that anxious to go back into the workplace, right? So, back to this thing about money, I agree, John, and with Leonardo too. I really, really think that people need to drop and go now and find and look for ways to invest money to earn an income. We're going to need to do that because I'm not sure if we've seen the total fallout of death by economy. I kind of like that. Does it not resonate how scary this is? Right? The whole thing. Death by COVID or death by economy. Actually, I found Dr. Chin quite fascinating and extremely well-versed on COVID-19 and very intelligent, you guys. I think that whole thing could have lasted 2 hours just with her. All the questions were for her. But I'm going to let you two speak because, John, I think we need to do this sooner than later. A lot of people are just sitting there frozen. So either we start making phone calls and getting people 10 at a time on one of these kinds of sessions. But I honestly see things a little differently in a year from now and 2 years from now. So now is the time, I think, for people to make their money work. Money work for you, not working for money. And people can probably retire if they make the right decisions, right? with their equity in their home. A lot of people in their 50s or 60s have equity.
Can I add the advantage of using that strategy is that you've shifted in a low rate lending environment. You've shifted illiquid asset just because selling a home is cumbersome and most people are not going to sell it. So you've shifted an illiquid asset, and part of it now has become fairly liquid, and that's power. Like, that is powerful.
It is.
Yeah, absolutely. I mean, if you've got all of your asset locked up in an illiquid home, and you run into say an income event or something like this, and you've lost your job and you can't get a loan, you can't get a mortgage. It's pretty hard to eat the equity in your house. But if you've shifted that to a liquid asset where you can spend that money for emergencies or generate an income for your future, it's definitely something to consider rather than have all your eggs in the one house. You can diversify, as Leo was mentioning, at least pull some of it out.
I agree.
We'll see rates this low. They're at historic lows.
At these historic, right?
Yeah.
Low interest rates. So tell us about interest rates before you say goodbye.
We still have 2.29% for an insured mortgage. So that's if you're buying a place with less than 20% down,
Right.
or if you're switching your mortgage at renewal time and it's currently insured. So when you bought it for less than 20% down.
Okay, how about conventional? How about a conventional deal? 2.5 or?
Well, if the lender is buying the insurance, you can get rates in that range, and up towards maybe 2.75 if there's no insurance at all. So we're still everything's way under 3.
It's still reasonable for sure.
Yeah.
Okay, so I'm just going to create a banner that's going to stream here. You tell me if this works. Look at this. Am I doing it right? Did I do it right? So take 100,000 of your home equity and make it work today at these historic low rates. Boom. Okay.
Yeah, and we really love the Scotia STEP product because you can set up in the home equity line of credit component, you can set up different sort of tax regimes. So you can set up an amount where you're borrowing the money to invest, and then it's very easy for your accountant at the end of the year to rationalize everything, and you can show exactly what component you use to invest and what component you use for personal use and things like that. It's a fantastic product, and great rates, looking at prime plus a half on the HELOC component. So that's 295 as we speak. And you're going to write off that interest against your investments, and Leo's going to make you 5%. So it's almost a no-brainer.
Let's that's minimum. I'm going to tell you right now, some of the things that I'm seeing in the markets, like a lot of other things are performing far better than that, Leo, from where they were a couple of months ago. Okay. And
yeah. I was referring to something that's
boring,
quite conservative, geared for people who are unable to stomach the first quarter that we've had this year.
Yeah, I don't know, for sure.
It's for people who like watching paint dry.
Yeah.
Portfolio.
Yeah, but then I think people need to take into consideration, where they are on that ruler, and how much time and they have, if it's 5, 10, 15, 25 years, right? So, and then we're also hearing rumors about, people think everything will soar back to where it was, that the price of oil will be $100 US a barrel. Wow. But I'm not sure where West Texas crude will be. I think Alberta's an anomaly. So. But this has been really fantastic. So why don't we set a little goal here, you two? This has been so terrific. I must say, I'm not exactly sure what happens then. Thursday is Thursday is Thursday. Every time you turn around, it's Thursday, which is a great day, Leo. I appreciate you coming and, educating us and sharing all this information. John, you as well. Even though we're in this still sort of quasi lockdown, don't you find that the whole day is just going every day? It's fast.
Yeah.
It's fast. We're already at the middle of May. That's craziness. So is it possible, and we can limit it to, it's up to you guys, to be effective? How many people were in your first home buyer seminar last night?
There were about a dozen. And what was nice about it for them was they didn't have to go anywhere. They didn't have to get dressed up, and they were very comfortable. Like, one was a couple sitting on a couch, having a glass of wine, and we were just providing them a complimentary education on how, the process of buying a home, so that the realtor walked through the process. And then I did an education piece on how the mortgage part works.
Perfect.
And, I got 2 emails this morning saying we want to get pre-qualified. We never heard anybody explain mortgages that simply. And anecdotally, one couple said they've had some friends going through an absolute nightmare trying to get a mortgage done. And had they heard what I was saying last night, it would have been all solved. So I think it adds a lot of value to people that, they don't really know. And, but we can help them as a team to surround them and give them, good education and good advice, and, kickstart a savings plan for their future. I love that first-time home buyer. It's literally free money for your future.
I think it's fantastic.
And nobody knows how long that's going to last. They originally set aside $1.25 billion, but given all that's happened and surprisingly, low traction with that product and low uptick, they can cancel it tomorrow. So if I'm a first-time home buyer and I'm sitting in a buyer's market in Edmonton, I've got free money from the government that's going to allow me to create a $120,000 nest egg by the time the house is paid off. Now I have a free and clear house. I've got $120K cash. I've paid off the government. It
makes sense. It definitely makes sense. So first-time buyers, okay, just to qualify, right? This is only available to people who have actually never ever owned a home ever before.
No, there's some wiggle room in there. So if you haven't owned a home in 4 years, for example, also if you're newly separated, so you can actually combine this with the spousal separation process, where one spouse can buy the house from the original for 5% down, plus have another 5% kicked in by the government. And, that extra little savings could go a long way if you're recently divorced and, now you're a single parent with kids and so forth. So they're really going out of their way to help people.
See, awesome. It's a good idea. Maybe we should get separated anyway. Anyway, so on that note, though, how long would it take you to approve someone for a $100,000 line of credit on their home, provided they qualify and all the other things? About a week?
Yeah, I mean, we have a fantastic underwriter, not to keep plugging away at Scotia, but he's very fast. And what we would do, rather than just set up a standalone line of credit, is we would review their existing mortgage, because that's my dog.
Hi.
Especially at renewal time, because we could potentially save them money on the mortgage component at the same time, set up a HELOC that can be used to unlock that illiquid equity in their home and put it to work.
Okay. Well, I guess you could get into whether their existing mortgage has a penalty and things like that.
Yeah.
So if that occurs, then that's a no. But
it depends. Yeah, if depends what the penalty is and what the new interest rate is, but it's particularly useful at renewal time because there would not be any penalty.
Okay, so do you think it's a little premature for us to say the following? Today's Thursday. I'm not sure what your schedule is like next week, but perhaps maybe Friday at a different time. It could be, say, 3 o'clock in the afternoon or 4 o'clock in the afternoon, right? That I'm going to call a few people because I've got a few people, Leo, that would be interested in talking to you. But I think in a group, we'll decide whether it's like this or it's just an audio conference call, right? That they can have questions.
Sure, let's do it.
Yeah, and John, you too. Yeah, they can ask questions, and these are people committed to doing exactly this. Okay, they want their money to grow, and really nothing's going on right now. And the concern is that, you know, the value that they have, as you mentioned, we've talked about this week after week. There are some people who are listening, and yeah, week after week, and they're not seeing, you know, any rapid upward increase in what they're doing. So, okay. All right. Well, why don't you message me if Friday doesn't work next week, then maybe we'll take a look at maybe doing it Monday's Monday's a holiday, but a Tuesday afternoon, maybe, you know, kind of quiet for you guys.
Yeah.
No, that sounds good. I think the idea is just to.
I find people don't mind coming together in, we'll call it a room, where there's maybe a dozen people or 10 people asking questions, yet they're still, you know, remain sort of anonymous, but they're in a seminar that they can ask questions, but they get to know you both. Okay? Right? And feel free. If 10, maybe 10, we'll limit it to 10 people. I don't know. That's a lot. Right? If they have 10, you guys decide. But we're going to be doing this, okay? And so that's why I'm setting a time limit and a goal. It's been week after week. We're chit-chatting about this. I know everybody's really busy, but there are new clients out there. There's a couple of them that are already Scotia clients. So that was wonderful. Leo, do you have a parting word for us? I know we kind of started a little.
No, I guess my only parting words is my function is to provide an investment strategy that works for you in regards to your specific needs based around retirement and financial planning and the use of investment tools, whether they be leverage or otherwise specific to pensions, RSPs, TFSAs, unregistered, etc., to help achieve those retirement goals. So if you do have any questions, please let me know, and I will be happy to connect.
Perfect. And Mr. John, same thing?
Yeah, we're here anytime you have any.
I love
my dog.
He must want to go out for a walk, so you
I
go
think so.
for a walk, right? I appreciate you being here today, right? So here, before you run off, can I say this, Leo, and turn it into, hang on, $200,000 in 10 years. Yay. 1, 2, 3, more or less, right?
What I sent you?
What's that?
What I had sent you in the chat?
Oh no, this is this. Hang on, show there. Is it right? Oh no, that's the wrong person. Okay, there. Sorry. Take 100,000 of your home equity and make it work today at these historic low interest rates, 2.5. Turn it in to 200,000. I didn't put the 10 years, but okay. But that's okay. They can always ask that question, right? Turn it into 200,000 in 10 years. You can explain that. See, who doesn't want to double their money? Well, you guys, I'm always amazed it's over. 1 hour goes really quick.
Super fast.
Yeah, super fast. Lots of information. Thank you again, both, for joining us today. And we look forward to seeing you next Thursday, right, live here. We did commit to being here until we move past COVID, and COVID is a distant memory. To listen to Dr. Chin, she thinks we're here for a while. So
Yeah.
Thank you, Dr. Chin.
Okay.
For that,
Well, thank you, everybody. Appreciate it.
Bye,
Ciao.
John.
Stay safe.
Bye, Sally.
Bye for now. Thank you. So, very interesting information, and that was all about an update from what we're seeing in the stock market from Leonardo, the estate from Scotiabank, and also John Cliff from the Mortgage Center. So I think what's resonating, there are opportunities to make your money work for you. So by all means, give us a call. My number is 780-441-5457. And as John and Leo say, perhaps maybe it's, if you're not thinking of a change, perhaps it's time to unlock some of the equity in your home and put it to work. So thank you for being here today. I look forward to seeing you tomorrow, Friday. Again, it's Friday. So it's Fun Friday, and it looks like the weekend is going to be beautiful. We might see 20, 22 degrees. So let's get some vitamin D. According to Dr. Chin, Canadians need to have far more vitamin D and C. So if you're not allergic to it, by all means, increase your vitamin D, get some more sunshine and vitamin C. And I will see you live tomorrow, 1 p.m. As usual, it's Fun Friday. It's been a very, very fast week. Take care. Bye for now.